Ladies and gentlemen, there's a data set published every single week that almost nobody outside professional trading desks bothers to read. And more than once in the last 50 years, it's told a sharper story about where silver was heading than any headline, any chart pattern, or any analyst on television. It comes out of a single exchange in New York. It's public, it's free, and it sits buried in a government filing most retail investors have never opened. If you hold silver or you're watching the price wondering what's actually driving it underneath the noise, what this data has been showing lately is worth understanding before the next move, not after it. Start with the basics because none of this makes sense without them. COMEX stands for the Commodity Exchange, now part of the CME Group, and it's the primary futures market where silver contracts trade in bulk. When people talk about the price of silver, they're usually quoting the COMEX futures price, not a price from some shop selling coins. Each standard contract represents 5,000 ounces, and most of the trading in it has nothing to do with anyone wanting to actually take delivery of metal. It's paper changing hands between banks, hedge funds, and producers, most of it closed out, rolled forward, or cash, settled long before any physical silver would ever need to move. That distinction, paper versus physical, is worth holding on to because it explains something that trips up a lot of people new to this market. The total face value of silver contracts trading on COMEX in a single day can run many times larger than the entire annual physical supply mined worldwide. That's not a scandal, it's just how futures markets work. The same way daily oil futures volume dwarfs the oil physically pumped that day. But it does mean the quoted price is set mostly by paper positioning rather than physical scarcity alone. And the gap between the two is where the more useful signals tend to show up. Every week, the Commodity Futures Trading Commission publishes the Commitments of Traders Report, usually just called the COT Report. It breaks down contract by contract who's holding what. Traders split into commercial hedgers, typically producers, refiners, and bullion banks using futures to hedge physical business, and non-commercial traders, often called managed money, which covers hedge funds and large speculators betting directionally on price. Commercials tend to sit net short, positioned to profit if prices fall or stay flat because they're hedging metal they already produce or handle. Managed money tends to go net long during rallies and net short during downturns, chasing momentum rather than hedging anything. When managed money positioning gets extremely one-sided, heavily long or heavily short relative to its own historical range, it usually means a large share of the speculative crowd has already piled into the trade, leaving less fresh buying or selling power to push price further the same direction. Analysts who track the COT report watch for these extremes as a contrarian signal, not because the report predicts direction with any certainty, but because crowded positioning has preceded sharp reversals more often than calm balanced positioning has. Traders have studied these extremes since the report's modern format was standardized in the mid-1990s, and the pattern shows up well beyond silver in crude oil, corn, even the British pound. There's a second piece of COMEX data that gets far less attention than it deserves: the exchange's warehouse inventory reports, which split registered silver stocks from eligible silver stocks. Eligible silver sits in COMEX-approved vaults, meets exchange purity and bar specs, but isn't earmarked for delivery. Registered silver has been formally set aside and is available to deliver if a contract holder stands for delivery instead of closing out or rolling. The ratio between the two and the total combined size of that vault inventory has become one of the more closely watched numbers in the physical silver market over the past several years. The ratio matters because it's a rough proxy for how much spare deliverable metal actually sits behind the paper market at any given moment. When registered stocks shrink relative to the number of open contracts that could theoretically stand for delivery, it raises a real structural question. If a meaningfully larger share of contract holders demanded physical metal instead of cash settling, would the exchange have enough registered silver on hand to comfortably meet it? This has happened before, and it reshaped the market when it did. Go back to 1979 and 1980. Nelson Bunker Hunt and William Herbert Hunt, along with partners in the Middle East, built an enormous physical and futures position in silver, at one point reportedly controlling more than half the world's deliverable supply through a combination of COMEX contracts and bullion. Silver ran from roughly $6 an ounce in early 1979 to nearly $50 by January 1980, a move driven substantially by concentrated buying pressure rather than any broad industrial or investment shift. COMEX and the CFTC responded by changing margin requirements and imposing position limits designed specifically to force liquidation, and the price collapsed by more than half within weeks, an event now known as Silver Thursday. It's still the most extreme case study of how concentrated positioning, physical and paper, can distort silver prices far past what supply and demand alone would justify, which is exactly why regulators still watch concentrated positioning this closely. More than 4 decades later, a very different version of the same dynamic played out in early 2021. A large, decentralized group of retail investors, organized largely through online forums, coordinated a push to buy physical silver, and silver, linked investment products, aiming to squeeze what they believed were oversized short positions held by major bullion banks. Silver spiked hard over a matter of days. Physical dealers across the US and Europe reported coins and small bars selling out almost entirely, and premiums on retail silver. The markup over quoted COMEX spot widened sharply as physical demand outran available retail supply for a stretch. The COMEX futures price itself moved far less than the physical retail premium did, and that gap is worth sitting with because it tells you which part of the market, paper or physical, was actually under strain, which leads to one of the more technical but genuinely useful signals COMEX data offers: whether the market sits in contango or backwardation. In a normal market, futures contracts for delivery further out trade a bit higher than spot, reflecting storage, insurance, and financing costs over time. That's contango, and it's the default state across most of silver's trading history. Backwardation flips that spot or near-term futures trading above longer-dated contracts, and it usually signals that demand for immediate physical delivery has gotten unusually intense relative to anyone's willingness to supply metal into storage for later. Backwardation in precious metals is rare, and it tends to line up with periods of real physical tightness, exactly where the registered inventory numbers start to matter most. Related to that is EFP exchange for physical, the mechanism that actually moves silver between the COMEX paper market and physical hubs like London, the historical center of bullion trading. When EFP costs, the price of converting a COMEX paper position into a physical delivery arrangement, spike or turn volatile, it usually reflects friction moving metal between those two markets, shipping constraints, refining bottlenecks, or a genuine mismatch between where silver is sitting and where it's wanted. EFP spreads widened noticeably in early 2020 when European refining capacity temporarily shut down and moving bullion between London and New York got logistically difficult, even though the metal technically existed somewhere in the world in sufficient quantity. Silver isn't purely a monetary metal the way gold largely is, and the physical demand side matters here too. Per the Silver Institute, industrial applications now account for a majority of annual silver demand, driven heavily by electronics and increasingly solar photovoltaic manufacturing, since silver's conductivity makes it essential to most current solar cell designs. As global solar installation has scaled up over the past decade, industrial consumption tied to that sector alone has grown substantially, a demand source that barely existed in any real volume during the Hunt era or even during 2008. That matters for COMEX positioning because a growing share of physical demand now comes from manufacturing order books and solar production schedules, not investment sentiment. And that demand doesn't just vanish when speculative futures positioning cools. Mine supply hasn't kept pace on the other side. Most silver isn't produced from primary silver mines at all. It comes as a byproduct of mining copper, lead, and zinc, according to the Silver Institute's production data. So silver mine output doesn't respond quickly to a rising price the way a primary commodity would, because the decision to open or expand a mine is driven by the economics of the primary metal, not silver prices. When industrial demand rises faster than byproduct-driven supply can adjust, the gap gets filled by recycling, by drawing down above ground inventories, including the COMEX warehouse stocks already discussed, or by price rising enough to ration demand. That structural inflexibility is a large part of why silver swings harder than gold in both directions. Worth comparing to central bank buying. The force behind much of gold's multi-year rally has been almost entirely absent from silver. Central banks hold gold as a reserve asset in a way they simply don't hold silver, largely because of gold's monetary history and silver's much larger industrial footprint, which makes it a less practical long-term reserve holding for a sovereign institution. One of the biggest tailwinds behind gold's run, sustained central bank accumulation, mostly doesn't apply to silver, which is part of why silver's price behavior can decouple from gold's for long stretches, even though the two get lumped together in casual commentary. That decoupling shows up clearly in the gold to silver ratio, the price of an ounce of gold divided by an ounce of silver. Over the past century, that ratio has swung from below 20 in some periods to above 100 in others, including a brief spike past 120 in early 2020 when silver sold off harder than gold as investors scrambled for cash liquidity across nearly every asset class. When the ratio sits at historically elevated levels, some analysts read it as a sign silver may be undervalued relative to gold and due for catch-up performance. Worth being careful with that read, though. The ratio has stayed elevated for years at a stretch without reverting, and using it alone as a timing tool has a mixed record across different cycles. If breaking down a data set most people never look at is useful to you, take a second to like this video and subscribe. This channel is built around the mechanism underneath the price, not the headline number. And genuinely curious in the comments, are you already watching COMEX inventory data yourself? Or is this the first time you're hearing that registered and eligible stocks get tracked separately? That distinction trips up plenty of people who've traded this metal for years, and knowing where you're starting from shapes what we cover next. Back to the data. Put these pieces together, and here's roughly what's been showing up recently. Registered silver stocks, the metal formerly available for delivery, have fluctuated a fair amount over the past several years, at times declining noticeably as large blocks shifted from registered into eligible status or left COMEX vaults entirely, often flowing toward London or into ETF holdings responding to investment demand. Total combined inventories remain substantial by historical standards, so calling the physical market an outright shortage would be wrong. But the direction of that inventory movement, building or draining over a stretch of months, has become one of the more closely watched signals precisely because it reflects real-time physical flow rather than a lagging statistic. At the same time, COT positioning has, at various points, shown managed money building historically large net long positions heading into delivery months March, May, July, September, December, the specific contract months when a larger share of open contracts get closed out, rolled forward, or less often stood for physical delivery. When open interest stays elevated heading into one of those months, while registered inventories sit on the lower end of their range, it creates real structural tension, not a guaranteed squeeze, but a setup with less margin for error if a larger than usual share of longs decide to demand metal instead of cash settlement. Worth being precise here because it's easy to overstate. A tight registered to open interest ratio doesn't mean a squeeze is likely in any given month. The overwhelming majority of contract holders on both sides never intended to make or take physical delivery, and the exchange has tools, cash settlement, rolling, and if needed, emergency measures like the ones used during Silver Thursday to manage delivery pressure without registered stocks needing to physically empty out. What the data reliably shows is where structural tightness exists, and tightness is the environment where sharp moves, when they happen, tend to happen faster and further than in a well-supplied market. None of this trades in a vacuum. Real interest rates, dollar strength, Fed policy direction, everything from the broader precious metals conversation still applies to silver's paper price on COMEX. Silver just adds another layer on top: industrial demand growth from solar and electronics byproduct, constrained mine supply, and a futures market where speculative positioning can get historically stretched. At the same time, the physical inventory picture looks tighter than at almost any point in the modern data record. Monetary-driven paper demand stacked on industrial-driven physical demand stacked on a supply chain that can't respond quickly. That combination is why silver has a documented history of moving further and faster than gold once a direction takes hold in either direction. It's also why silver is harder to predict precisely than gold, since it answers to two different demand drivers: investment sentiment and industrial consumption, that don't always move together, on top of a supply side that behaves nothing like a typical mined commodity. So what do you actually do with all this? Skip chasing the headline price day to day and watch the same handful of signals professional desk watch. Track managed money's COT positioning against its own historical range. Since extremes in either direction have preceded larger reversals more often than compositioning has, track registered versus eligible inventory and which way it's moving, since that tells you about real physical flow rather than sentiment. Watch for backwardation or a widening EFP spread, among the clearest signs that physical tightness is a genuine constraint rather than a talking point. And keep an eye on the gold to silver ratio, not as a precise timing tool, just a rough gauge of whether silver looks historically cheap or expensive next to gold. Silver's price on any given day looks like one number, but underneath it sit two markets moving at different speeds: a paper futures market where speculative positioning can swing hard within weeks, and a physical market constrained by byproduct mine supply, industrial schedules, and a finite pool of registered inventory that doesn't refill overnight. Most of the time, those two markets drift along loosely connected without much drama. Whenever they've pulled sharply apart, the Hunt's concentrated buying in 1980, the pandemic logistics breakdown in 2020, the retail squeeze attempt in 2021, the resulting moves have been faster and larger than almost anything else in commodities. That's why this data is worth checking regularly rather than only after a headline hits. The COT report and the COMEX warehouse figures aren't flashy. They don't generate the kind of buzz a viral trading forum post does, but they've told a more honest, more real-time story about where structural pressure is actually building than almost any other public data set in this market. If you found this useful, subscribe. We'll keep tracking these numbers as they update, so the next time silver moves suddenly, you already understand what was building underneath it